to this special webinar to discuss the latest situation with the U.S. Iran conflict. We'll discuss the economic and market implications. My name is Tai Hui. I'm the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management, and I'm delighted to be joined by my teammates and colleagues, Kerry Craig, our Senior Global Market Strategist based in Australia. So, Kerry, thanks for your time.
Thank you, Tai. Great to be here. Thank you for those dialing in today.
Yeah. So, look, it's been a very busy start to the week. Obviously, on the February 28th, last Saturday, U.S. and Israel have launched an airstrike on Iran, really doing a number of damages. But at the same time, the Iranian reaction has been pretty strong. So what we try to do today is not necessarily to focus on the geopolitics. Of course, we'll look forward to discuss that in a moment, but mainly focus on two things. One is the macroeconomic implications of what's happened so far and where this could bring us in the future. Obviously, there's a number of scenarios. We'll discuss that as well. But of course, most importantly, from our perspective, what does that mean for portfolio discussions? What does it mean for portfolio constructions? And also in terms of markets, where do we go from here? So Kerry and I will split the next 30, 40 minutes on this number of issues. And of course, we do have time for question and answers as usual. Now, just before that, I know we were doing this call on a Wednesday, but actually since the start of the week, we have been launching a number of publications for our clients across Asia Pacific. So on Monday, we released our On the Minds of Investors, really our first reaction to this particular situation, what to watch out for. And of course, really trying to summarize a lot of the news flow that we have picked up over the weekend, alongside with our On Investments podcasts, hosted by myself. All these are available on our website. So after this seminar or this webinar, if you're interested, you can go back to our website and get those papers. I think it's really worth. So maybe to kick off, Kerry, if you don't mind, maybe just give us an update on the latest situation when it comes to the military conflict, and also some of the potential indication for next steps, as well as, most importantly, the situation with the Strait of Hormuz. If you can give us an update, that'll be a great way to start.
Certainly, thanks, Tai. I mean, like many of the audience and yourselves, we're monitoring the news flow for what's coming out. It doesn't feel like there is too much to suggest that the duration of this conflict will be anything other than lasting for a number of weeks. And we listen for and look for any indication that the two sides may be coming together to at least start discussions around a resolution. However, not hearing that yet. And the messaging we get from the administration in the US, well, according to what we're seeing in the news or looking at press conferences, does seem rather mixed when it comes to the outlook for this conflict. So I think the market is still thinking about something that will not be prolonged in duration. However, we are very cognizant of the fact that this could go for a little bit longer in a number of weeks, and the market is not yet pricing in something that could be that significant. Except that on that, there has been some developments when it comes to thinking around the next steps. I think a little bit worryingly, we've seen attacks on the US embassies in the Middle East. That could cause a case for an escalation and further attacks coming from both Israel or the US in terms of the aerial strikes. And so, again, not really an indication that things are going to calm anytime soon. When it comes to the outlook for shipping and the Strait of Hormuz, obviously that's been front and center in many people's minds, given the impact on the energy market and oil prices. We do have this map that we use from our Guide to Alternatives. It was mainly there to discuss the implications around tariffs and shipping routes, but I think a very useful one when thinking about how we see the developments in the Strait of Hormuz and potentially the knock-on effects to other markets and other shipping routes around the world. I would say effectively for most Western shipping companies, the Strait of Hormuz is closed. There has been a significant decline in the volume of oil that is now flowing through that strait. For context, it would typically be around 20 to 25 million barrels a day that would flow through that strait, about 20% of the oil production, and the latest indication that it's around about 5 million barrels, and most of that being done by sort of Russian or perhaps Iranian ships themselves rather than by Western ships. So you can see that choke point there on the page as being something that's quite significant. When it comes to other goods that through the strait, I mean, there is some context around the import of food into Iran that comes through that strait that's worth noting in terms of the reason to keep the strait open. And also thinking about the impact on other shipping, such as containers. It's not just about energy in terms of oil and natural gas. We have seen container ships come down quite significantly, but that represents a very small share of global container shipping that goes through that strait. It's only about 3 or 4% of the global total. Most of that container shipping happens through the Suez Canal, Strait of Malacca, or thinking about the Panama Canal. So those are the really ones we're thinking about the impact on goods. Now, there could be a bit of a flow-on impact, obviously, if we see shipping routes have to move to, say, going around the Horn of Good Hope, or having to move through those other shipping routes, such as the Suez Canal or the Panama Canal. That can create pressure on those points. That can actually add to some of the shipping costs that come through in terms of freight costs, as well as delays in terms of those goods coming through, creating a bit more of an inflationary impulse outside of energy by itself. But for now, the focus is on the fact that we do have that closure of the strait, and that those flow-on effects may take some time to materialize. The other news that came out, Tai, that's probably worth noting, and you would have seen the headlines this morning, has been around the US president's move to announce that the US will effectively backstop or ensure shipping companies for moving their ships through the Strait of Hormuz and provide some sort of naval convoy to protect them. Details on that are still relatively light. This is something that has been done in the past. There is legislation in the US that would allow for that in terms of funding that insurance cost. However, I think the take-up is something to be mindful of. Just because it is there and available to shipping companies, they may be contemplating some of the operational or logistic risk from actually using that and not really thinking about some of the financial risk around insurance. Certainly, I think if the insurance premiums have gone up, freight costs have gone up, shipping companies can cover those. And if we think about what that means over the life of a shipping contract, it's probably not that material in terms of those shipping costs. So operational and reputational risks are probably something more in line with how that may play out. Certainly, we've seen the oil market react a little bit positively to that news and come off the very high levels we had overnight. But I think that's, again, something we can't guarantee in terms of creating that shipping route to be open. The positives, though, I would say, is that, again, it does feel like neither side wants to close the Strait of Hormuz, which is very important for thinking about what it means for that flow of oil into the rest of the world. Even if it does remain effectively shut for now, we haven't seen it being completely blockaded, which I think would be much more concerning, thinking about the knock-on effect in terms of oil prices and inflation a little bit further down the line. In terms of other cargo, I mean, there's obviously the knock-on effects we've seen in airports being closed, some of the attacks on airports around the region. Obviously hugely disrupted for passenger travel. Some airlines are now flying some routes out of the Middle East to try and clear that backlog. But again, when it comes to when it comes to goods shipping, it's about 15% of the world's airline or air freight goes through that region. So not insignificant, but I think it's mainly the maritime shipping we should be focusing on in terms of where we might see those inflationary consequences come from in the future. So that's the broad status of play, Tai. Unfortunately, not too much positive news to pass on in terms of where we're heading with the duration. No real resolution in terms of how long it may last. It does feel like the severity may have got a little bit higher overnight with some of the attacks that are continuing and some of the rhetoric we've seen so far.
No, thanks, Kerry. I think these are really important developments. And of course, things will continue to evolve over the next days, maybe weeks. And we're obviously here to help you to navigate these more challenging environments. I think coming back to both some of the uncertainties that Kerry mentioned in the first part, it's important to recognize that I think it's still not completely clear the objective of this military action from a U.S. perspective. Obviously, I think the Trump administration did mention they want to take out the nuclear facilities, the missile capabilities, maybe for regime change. But in the last 48, 96 hours, the narrative continues to change. So I think once we get some clarity in terms of the actual objective of this operation, then maybe we can then deduce what could be the next steps from both the U.S. and Israeli perspective, but also a potential response from the Iranian authorities. So let's come to the point about the economic impact. And I just want to quickly start off with the energy market. Obviously, we've seen oil price move up towards $80 on the Brent crude in the past 2 days. And just to put things in perspective, obviously, we've been through a number of geopolitical conflicts in the last couple of years that have led to an increase in energy prices. And to us, we've always argued that not every geopolitical event it would be influential on economies or the markets. We have to ask what could be the transmission mechanism. And frankly, for the past few years, we've always argued that the situation in the Middle East is most likely to come through the energy markets, as Kerry mentioned. And it's not just about Iranian production itself, but also more importantly, as everyone knows by now, the logistics that goes through the Strait of Hormuz. So if we just put some numbers around some of the recent geopolitical events, we look at the Russia-Ukraine war, Brent crude rose from $98 per barrel to $120 per barrel, a 31% increase in less than a month after the the Russia invasion began. If you look at, for example, back June last year, during the build-up of the U.S. bombing of the Iranian nuclear sites, Brent went from $64 in early June to ultimately $79. So again, hopefully this gives you a sort of a different magnitude of how far energy price could go, depending on how disruptive the supply is going to be. And just for perspective, Russian oil back in 2022, production was about 12% of global production. And if you look at the Strait of Hormuz, as Kerry mentioned earlier, it's responsible for about 20% of crude oil as well as refined products, and also a very significant component of the liquefied natural gas. And all of these could have a more significant impact on energy prices if that blockade happens and happened on a more sustained basis, let's say, several weeks, if not 2 or 3 months. So from that perspective, I think the market consensus is for a blockade to take place, and in a sustained way, oil price could be at $100, even $120. I think that is reasonable. But of course, that is very much uncertain at this point, depending on what Iranian really wants to do. And also, as Kerry mentioned earlier, what could be the potential response or the solutions offered by both the US and maybe the broader Western allies when it comes to this type of situation. So obviously, from that onwards, the question then becomes, what could be the impact on growth and inflation? Now, I think it's important to recognize that we are in 2026 in a reasonably good spot when it comes to growth. We've always argued that with the US, especially with the tax rebates coming through in the first half of the year, as well as the ongoing CapEx spend relating to artificial intelligence, the US economy could easily grow above trend in the first half of 2026 and then ease back towards trend at, say, 1.5% to 2% by the second half of the year. So the starting point is for the global economy to be in a reasonably good shape. Now, of course, all these uncertainties could increase the level of uncertainties, and as a result, business and household anxiety. So if you look at, for example, some of the more recent PMI numbers, I would argue that they are in a pretty decent place. Again, when it comes to manufacturing, the AI development is fueling growth in US and to a great extent in Asia as well. If you look at the numbers from Taiwan, South Korea, Japan, I think overall, the growth outlook for both the US and the APAC region is actually in pretty good shape. But of course, as I mentioned earlier, if there are going to be extended disruptions when it comes to energy logistics or energy supply, that could change really quite quickly. So that it remains that a bit of a potential turning point from that perspective. Inflation-wise, if you look at the correlation between gasoline prices in the US and crude oil prices, again, obviously that's going to be a very strong correlation. If oil price does hit $100, you can expect 75 cents to $1 increase in gasoline prices. And what that means is for every $10 in increase in crude oil, you can expect somewhere around 15 basis points increase in headline inflation in the US. So what you can get into then is arguably if oil price gone from $60 to $80 right now, and eventually because of disruptions goes to $100, that's a $40 increase, which means intuitively you're going to get around 60 basis points increase in headline inflation, and that's really just mainly coming from gasoline, there could be second round effect that could push headline inflation in the US higher. So I think from that perspective, you're not going to get a shortage of energy in the US because US is a net exporter of energy, but ultimately gasoline prices will still be correlated with global prices, so that relationship holds. And I think that would put the Fed in a rather difficult situation for two reasons. One, obviously, inflation is accelerating once again. If oil price does hit $100 in a sustainable way, and that really just throw the potential rate cuts later this year maybe out of the window. But at the same time, don't forget higher gasoline prices, and usually that often come with higher food prices as well, because food and energy have a very strong correlation when it comes to prices. A lot of food stuff, of course, requires fertilizers, which is often a derivative of crude oil, and also transportation. So what that means is a lot of the low-income households, maybe low to mid-income households, could have a really difficult summer because of more expensive gasoline and food. And that in itself takes away disposable income, your consumption, even with the tax rebates on tips, overtimes, and Social Security, that could actually dampen some of the headline growth on the consumption side. And of course, with higher energy prices, what does that mean for electricity costs in the US? What does that mean for the corporate sector, especially the tech sector, that is requiring that electricity to obviously feed into the data centers? So all of these could also pose a bit of a downside risk to growth. So you have this rather undesirable stagflationary combination where headline inflation is picking up, but there's more downside risk to growth because higher cost of living or higher cost of operation is eroding purchasing power. What that means is the Fed may obviously have to slow down on its plan to cut rates. If anything, I don't think they will look to raise rates aggressively, but I think the market was already repricing the prospects of rate cuts later this year. Now, ultimately, there's always been a debate amongst central banks, especially in developed markets. If you have a supply side shock, should you raise rates accordingly? I personally think no, because of two things. One, higher rates doesn't really help very much in terms of bringing those prices down. People are not going to drive less or eat less if food and energy price goes up or because of high interest rates. But more importantly, the lagged effect of monetary policy, it takes time. If you raise rates today, the impact won't be really felt in the economy 6, maybe 9, 12 months down the road. And what happens then in the Middle East or more broadly in the oil market, frankly, is anyone's guess at this point. So I suspect the Fed will have to just to be a lot more cautious when it comes to running the risk of raising rates in the face of high inflation brought by supply side shocks such as energy prices or food prices. So this is where we are. Now, when it comes to Asia, I think it's important also to recognize that the Strait of Hormuz is really critical for our region's energy supply. So on the right-hand side, what you see on this page right now is the oil flow by volume to a number of Asian economies, including China, India, Korea, and Japan. Now, we will supplement this chart with a percentage of how much it comes from the Strait of Hormuz, but I think it's rightfully argued that a significant chunk of oil supply for Japan, for Korea, for China actually comes through that particular part of the world, not from Iran, but from Kuwait, from the UAE, from Saudi Arabia. So I think from that perspective, well, the good news is many of these economies, they do have months in terms of oil reserve. So if there are disruptions for a few weeks or even 2 months, it may not be that critical. But as the disruption become more extended, if it becomes more extended, then obviously the stress on these economies could become more significant. And obviously then the question then becomes, is that going to impact on global supply chains, especially when it comes to technology in terms of semiconductors and memory chips? Ultimately, again, oil and gas are really critical ingredients, not just to give energy to the plants, but also to provide the chemicals that often goes into these hardware. So I think we continue to watch that space, but I would say that the Strait of Hormuz continues to be a really important lifeline for Asian economies. Unfortunately, it's very difficult to find alternatives at this point in time. And finally, just want to maybe think about scenarios. Obviously, the ideal scenario is for the conflict to subside as soon as possible, and therefore, the energy market can revert to normal. Unfortunately, as Kerry mentioned earlier, it seems like the operations can continue for maybe a few more weeks. And as I said at the start of my sharing, unless we get a clear objective of what the U.S. government wants to achieve, it's not really clear what could be the next steps to achieve a ceasefire or temporary, at least some sort of stability back in the region. And the other thing is, when it comes to the potential retaliation from Iran, we're already seeing not only the threat of blocking the strait, but also actual attacks on oil facilities across the region. How quickly can those facilities be brought back online? That remains to be seen. But we're monitoring not only the logistics through the strait, but also potential damage to production across the Middle East Gulf region, really to understand the potential longer-term impact on energy. Now, of course, a more sustained blockage, or as I mentioned earlier, a more severe damage in terms of oil facilities across the region, that could raise energy prices. That's, again, coming back to the scenario of $100, if not more, in a more sustained way. And that could bring us to a much more challenging environment when it comes to both the economy, again, high inflation, weaker growth, the sort of stagflationary sense of what could happen. But at the same time, the overall driver of growth in the last few years, especially with AI, could we see again more disruptions because of the lack of compute, because of the lack of both energy driving those data centers, but also the lack of hardware that will go into the build up, the capex of these data centers. So I think the potential impact could be quite far-reaching if we get into the worst-case scenario of a much more sustained disruptions when it comes to energy supply, both in terms of logistics, but also the production of energy. Now, before we move on to get back to Kerry on the markets, one thing we did mention at the end of last year, when we look forward to 2026, we've talked about the risk scenario. We did highlight that the worst case, from my perspective, is going to be a return of supply side shocks, because that's what we went through in 2022. 2022, frankly, was a perfect storm of inflation. You've had Russia, Ukraine, as I mentioned earlier, lifting energy prices as well as food prices. But at the same time, the world was coming back into business after COVID. So on the demand side, you've got this huge pickup with activities. On the supply side, you've got this cutback in energy supply. That created a perfect storm of inflation, which led to both stocks and bond having a really, really hard time. Now, hopefully, we don't get that. But again, if a supply side induced inflation leading to a sustained inflation environment, that again is a scenario that we find a bit more difficult, but not impossible to deal with. So now, with that really difficult question, I'm going to hand back to Kerry to share a bit more on what we should be thinking about in terms of portfolio construction and particular assets that we should be thinking about, and also how do we hedge against these scenarios. So, Kerry, back to you.
Thanks, Tai. I mean, great points. One of the common things that's been coming up with clients the last couple of days was initially about the relatively muted market reaction on Monday. I guess as people just digested what was happening, it's quite a shock to come in to the office and know that this has happened over the weekend and try and figure out what it means in the long run for positioning. And then I guess the other thing that's come up is about the performance of markets in terms of traditional safe havens not really showing their safe haven status, or the ones that we would think about being maybe somewhat dampened in terms of their status, like the US dollar, given some of the more political concerns that had been behind that, actually showing some strength of late. So it's a little bit hard to navigate this. So I want to talk a little bit about the oil market. We'll talk about the safe havens. As a question there about gold we'll come on to, as well as thinking about equities and broadening exposure in terms of providing greater diversification and some hedges in a portfolio overall. Just starting with that point around the oil market and some of the things that Ty's already picked up on production. I mentioned around the insurance that the US government is willing to offer, the naval protection for moving through the Straight of Hormuz. There's a question there about whether we expect that to mean the oil price has peaked. You can lead a horse to water, you can't make them drink. And I think it's all going to be about the take-up of shipping companies to that offer and to move through it. And that will have to be some of the things that we look for and monitor to see if it actually does increase. Right now, I think there might be a little bit of hesitancy, but it's just something we'll have to see. And that will largely dictate whether that does have a dampening effect on the oil price. It certainly did take a little bit of the heat out of the oil price when it was announced coming forward. On the oil market, it's worth noting that when I was looking at the futures this morning, the Brent futures was still about $85 a barrel. But, you look forward 3 months on those futures and it comes back down to $75 a barrel. That could be an indication that the oil market is pricing in something that's not going to be prolonged into that conflict. Or it could capture that storage costs are going to rise quite significantly and people don't want to hold oil. They really want to move it away pretty quickly. And that really comes back to that production concern that Tai just mentioned there. So it does feel like there's not a shortage of oil around the world. We can see that crude oil production on the left-hand chart here. We look at the OPEC number is below its peaks. We've had OPEC announce about 200,000 potential increase on the weekend to its oil supply. That is certainly there. It's not enough to mitigate the sort of 3.5 billion or 4 billion barrels of oil, million barrels of oil that come out of Iran, or some of the closures around some of the oil fields we may see over the Middle East. It's not going to replace that. And I think the issue is not the production of oil at the moment. The issue is about that flow of oil and the storage of that oil, which is quickly filling up, given that we don't have the ability for that oil to get out of the Middle East in a strong way at the moment. So that is really what it will probably drive the oil price in the very short term. As that storage capacity fills up, people want to move that oil away from their books. They're willing to try and push those prices higher, and that's really going to be the pinch point. And if that continues to happen, you see more of that production being shut off as there's nowhere to store it. And again, if there's limited ability to bring ships in to move it out of the Gulf, then again, that can cause that squeeze that comes through. So again, the right-hand side of the chart just shows you there is capacity available in certain markets. But again, I think it's about that flow of oil. And then as Tai mentioned, if we do see further attacks on refiners or production within the Middle East, what that means that when the Strait does eventually reopen, how much of that oil supply can come back on and how quickly to address some of that imbalance. But certainly looking at the futures market, it doesn't look like it's pricing in anything too significant in terms of a long-term play in terms of where we're heading. Some of the other things, the safe haven behavior that's coming through, I think I'll start with gold, given that's one that's probably surprised me the most. And we have that question come through around where gold is heading. So gold was, set at peak of around about $5,500 US dollars earlier or this year. It's come back down to about 3,500 earlier the week. Now it's down to about 5,100. A little bit surprising if we're thinking about the inflationary consequences of what's happening, that we wouldn't see the gold price move a little bit higher as a hedge against both that geopolitical risk and that inflation. I think this does reflect some of the repositioning that we expect to see in portfolios. It comes back to that scenario outline that Tai went through in the base case. Right now the base case is still for a global economy that's expanding, supportive fiscal policy, potentially supportive lagged impact of monetary policy as those rate cuts still move through, and thinking about that context for cushioning some of the risk that we're seeing coming out of the Middle East. And so that allows that for repositioning in markets. And if you're holding an asset like gold, some of the equity markets that I'll come on to that have done really well, you might just be wanting to take a little bit of that off your books in terms of positioning to be able to allocate to other assets that add to that diversification, defensiveness in a portfolio, or just thinking about being able to allocate back to the markets when perhaps the outlook does start to improve. I think when it comes to gold, we think about it longer term and its role in a portfolio. It certainly has become something that's a little bit more significant as a holding. And we did cover this in our long-term capital market assumptions last year. And the chart on the left-hand side captures this in terms of those shifts in regimes we've seen across time and how it's impacted the gold price. So that chart is at a log scale. So we're not saying the gold price is at 10,000. It's a log scale of the gold price. But you can see you've gone through that period of stagflation back in the 70s when we had concerns around oil before, and we saw that big lift in gold. Obviously, we had that extended periods of negative real rates where gold was something you wanted to own, but fixed income wasn't that attractive. And then more recently, these geopolitical concerns, you go into some of that debasement trade that's come through as well. So I think there's probably going to be some support for gold. It was that central bank buying. I think it's probably more of those hedging coming through. And so gold can have that role in a portfolio. It's relatively still a small allocation in our mind, but it has to be significant enough to do that effect of diversifying the portfolio as well. So I think there could still be some upside to the gold price from here. And again, it's something to look at in a portfolio to hedge against some of these risks at the moment, and certainly something that's going to add a little bit more diversification when it comes in to the portfolio overall. When it comes to other markets, we're thinking about the treasuries and how they've behaved and thinking about the movements in currencies. It's quite notable when we look at the bond market, 10-year yields across most major developed markets have moved higher. If we think about what's happening in the US 10-year is about 10 or 12 basis points higher. When we're thinking about what's happening in Europe, the German market is also higher. And we're also seeing the Australian market move up quite a lot. So we have about almost 410 on the US 10-year. We're at 480 in Australia, and the UK is at 440. So again, it's reflecting some of those inflation concerns coming through that's driving those yields up. We've seen the short end of the curves move higher as well as the markets start to price out potentially some of those rate cuts coming through. Even a bit more of debate about whether the European Union or the ECB may be forced to hike rates in this environment. We talked a lot about the oil outlook. Tai touched on gas. The European Union is still very reliant on natural gas for both its sort of residential energy as well as commercial energy. We saw that big pain point when we had the Ukrainian-Russia conflict. Oil futures on the Dutch basis jumped up to 250 euros a megawatt hour. It's currently at about 54, so significantly higher than when it was just last week. And so that can create some knock-on effects to inflation. Again, it's about that pass-through and the permanency of that, but I think we will see that inflation spike kick in Europe. And in fact, the inflation numbers that came out today a little bit firmer than being expected. So that repricing of the outlook for rates across the board is something to be mindful of, and central banks perhaps wanting to be, a little bit mindful of where inflation goes in the short run, but also the long-term growth shocks that may come through with this as well. It does feel like it's inflation rather than growth for now overall. So based on that, moving heavily into duration and out the curve, at least a steeper curve gives you paid for duration, but with these inflation concerns coming through, potentially it's a little bit high to go really long into the long end of the curve in this environment, and we could see those yields move a little bit higher. I do think if we did see yields back up significantly from here, that would create a more of an opportune point to enter into a bit longer duration as we start to think about yields that can come down if this does develop into more of a growth shock and really provide that hedge against it. But while the concern is more around the inflation, we think about holding probably duration that's more in line with where bond indices sit in terms of the duration, or a little bit shorter in terms of being between 5 and 7 years, where you're kind of in a little bit of a sweet spot there. The US dollar, in terms of that safe haven status, again, we've seen the dollar move about 1.5% higher on a DXY basis over the last couple of days, so it is picking up that. We haven't seen the yen benefit from some of that safe haven buying. Again, it comes back to that story around the fact that we have seen those pressure points around the economy as an importer of energy coming through, but the Swiss franc has started to move higher as well. So safe havens in that traditional sense are coming back, and there are ways there to hedge your portfolio overall. But I think the main message here is about that rebalancing to ensure you have a wider range of those safe havens, those hedging against that risk in a portfolio, because we're not really changing that base case view of what we still see as being the strength in the corporate earnings coming through in many markets around the world, the strength in the economy that's been quite supportive of that. And again, not having a very clear read through in terms of the duration of this conflict and how that may move. So not really seeing a huge risk off move. I think it's more a case of thinking about some of the profit taking, perhaps, if you want to put it that way, or the reallocation away from what's been quite strong positions, such as what we've seen in the performance of Korea, Taiwan, or in certain sectors overall. Because it does come back to this point, and I think it's a well-trodden path, and one the audience is probably very familiar with, that the markets do recover from these shocks relatively quickly, unless it does create a more prolonged downturn or a very strong shift in the economic outlook. So unless we start to really think about this becoming something that's going to be recessionary, the markets tend to recover quite quickly, and unfortunately, in many cases, can become desensitized to some of these conflicts. If we did start to see oil flow through the Strait of Hormuz, but the conflicts continue within the Middle Eastern region. So the chart or the table here on the page in front of you just shows a range of geopolitical conflicts over time, going all the way back to 1973, the duration of that conflict, as well as the short-term fall in the market and in the number of days to recover. The median there is 13 days. There's obviously some very strong outliers with the Israeli-Arab war. But most of those more recent ones, if we look from, say, 2001, have been actually relatively short term. So the timing of trying not to time the market is a very important message we would like to get across at the moment in terms of making any sort of rash decisions about heavy selling in this environment where the market could quite quickly come back. And that is unfortunately the nature of geopolitical risk when we think about some of the concerns and how difficult it is to account in a portfolio overall. In terms of the markets and the behavior around the Asian markets and the EM particularly, I think the AI theme is something to also bear in mind in terms of the stronger supports we've seen for emerging markets. The dollar could be a little bit of a headwind, but we don't see those big current account problems that we have in the past with many emerging economies. They're probably on a surer footing than they were in the past, and they have some of this tailwind when it comes to those North Asian markets, when it comes to that role in the supply chain for many of the AI build out we're seeing in the US and that capex flow coming into Asia as well. So things to bear in mind, both in creating some fiscal space for support for the market, as well as the earnings outlook for the market, given they have performed quite strongly overall. When it does come to thinking about positioning across sectors in the market, obviously defense, energy, and ones that are performing quite strongly, they may continue to do so. Given the valuations are moving up, it could be a case of just thinking about the prospect for the longer term returns there. And I think when we come to markets like Europe, which we've talked about that rotation away from the US and international, that international diversification still makes sense, and investors may be questioning whether that can be prolonged as we see perhaps a movement back to some quality assets in the US. But come back to what was driving the European market overall. It was around that fiscal spend that was coming through, that was announced and starting to feed through into the economy this year, which is very significant. A lot of that fiscal spend was directed at building out infrastructure, building out energy security and reliability, building out defense capabilities. And if anything, a lot of the last few days have just reinforced the need for that spending and that messaging, and again, the prospects for that economy in the long run. So I think there could be a case for arguing that this may, again, feed through into some of the longer term narrative we've been talking around, the reasons for that international diversification, and again, why we wouldn't necessarily expect to see a wholesale rotation back towards the US market and that sort of movement towards back to growth or quality in a wholesale fashion at the moment. So some messages there around just ensuring we have adequate diversification and adequate number of hedges in portfolios. It's not just about gold. It's not just about currencies. I think ensuring that diversification across sector mix is also going to be very important. And finally, just on the cash side of things, again, markets tend to shoot first, ask question later. This chart, I think, does an excellent job, and if you put it in front of your own clients, a great one for showing the recovery potential in markets around their geopolitical conflicts. Just to walk you through the chart, just looking at a 60-40 portfolio, its performance against cash from investing a 1 month before the conflict starts in these cases, or 1 month before that geopolitical event. And you can see over a 1 year period, 75% of the time the market does bring back those gains to about a 7% average return over cash for that portfolio. And then over a 3 year time frame, it's 100% of the time it will outperform cash over that portfolio. So as markets get nervous, as investors get jittery, I think it's a great case to fall back on. Again, we know a lot of this geopolitical risk is very hard to time in a portfolio. That construct that Tai talked about in both terms of growth shocks and in terms of inflation shocks can make portfolio construction extremely difficult, but moving heavily into cash has not been the answer in the past, and we don't think it is the answer in the future. What investors may like to consider is moving a little bit more into inflation and GDP less sensitive areas of the market, and it does lean heavily towards thinking about private markets and particularly real assets. If we think about infrastructure, again, the need for a lot of infrastructure build out we're seeing around the world, as well as even transport, ironically, given we are still seeing a need for oil and energy shipped around the world as many other goods, even if it has to take a slightly longer path to get to where it needs to go. So those bubbles on the left-hand side of that chart, those are the ones that have that low correlation with stocks and bonds. Those are the ones that provide those diversification. And that bubble is very large, and that bubble indicates yield, provide that consistent income, which again can be defensive within a portfolio overall. So the build out of thinking about the role of alternatives in a portfolio for times, not just around geopolitical risk, but for broader diversification, again, has been amplified by the last few days in our mind as well. So I think there's a few opportunities there for investors to think about in their own portfolios. I think the big one for me at the moment, though, is around that sort of broad risk off movement. I think a lot of the investors internally we talk to are looking at their risk mitigation strategies, are looking at the value at risk in their portfolios and assessing that, but they're not necessarily moving into big wholesale changes in the way they're approaching the markets, given there is a degree of uncertainty and a wide range of scenarios that could still play out in this environment. So a rather boring message, a rather dull one, but one that's tried and tested, is just to stay invested at the moment, Tai. But I'll pass it back to you.
Great, Kerry, thank you very much. I think the boring is probably what we would like right now, given all the news flows in the past few weeks. But I just want to bring it back to one particular table that I thought was really interesting. If you think back to page 9, first of all, I think when we say panic first, it's like not we tell you to panic first. It's the market usually panic first and then think later. But one thing that you'll notice is that over time, the impact of energy-related shocks on markets have come down. I think that is very much relating to the fact that the energy intensity of our economies have come down over the last 20, 30, 40 years. So if you think back to really the 70s, neither of us are, well, we were born in the 70s, but we were kids back then. But the reality is, the energy intensity was much higher. The industries, the car use, et cetera. What that means is they're much more exposed, or the economy was much more exposed to high energy prices. Right now, we've got a more diversified energy production base, especially in Asia, where renewable has really made a strong headway in the past few years. So I think all of which does suggest that the economies do have more resilience towards high energy costs, even though it's not completely immune. But I think it's important, as Kerry said, two things. One, diversification is absolutely critical. And more importantly, the ability to stay invested, to me, is really important during this time of heightened volatilities. And maybe the third question would be, can we make use of that volatility to generate returns? For example, option strategies during volatile times. Obviously, if you sell options now, you should get better compensated. So I think that I did mention at the start, if we don't know the objective of the strike, it's much more difficult for us to predict or anticipate what's to come. But at least we do have the solutions from a portfolio construction perspective to help our clients to get through this really turbulent times. So hopefully, we have given you some ideas to work with. Thank you very much for joining us today. We will have more, both in terms of written commentaries, podcasts, webinars to help you to navigate this environment. Obviously, if you have any questions, feel free to reach out to your JP Morgan Asset Management kind of advisors. Our next call is going to be on the 19th of March, so not far from now, 15 days. That was supposed to be the next Fed meeting. But let's see where we are with the Iranian situation. I probably will spend quite a bit of time not only talking about the Fed and the FOMC, but also in the context of where the world would be in a few weeks' time. So thank you. Stay safe and have a great week ahead. Thank you. Thanks, Kerry.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. J.P. Morgan Asset Management is the brand for the asset management business of J.P. Morgan Chase and Company and its affiliates worldwide.